I want to first off saying that there's nothing untoward the Magnificent Seven. Those are great names. NVIDIA is a great company. Meta is a great company.
Yeah.
It's just that you want to make sure your concentrations are appropriate. And I think that's, to us, the most important part is, yes, you absolutely need the Facebooks, the Metas in your portfolio, but you want it to drive your entire return. And that's where the diversification matters. These companies will not go up forever. That's where the diversification helps. And especially if you're singularly focused, those Magnificent Seven are all somewhat interrelated companies now. You saw now, they're all investing in each other. It's part of the AI boom that's happened.
Wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day.
Well, I'd like to welcome everyone to the Money Mindset Mastery podcast. I'm your host, Jim, and joining me today, as always, is my co-host, Ryan Genoe. Ryan, how are things today?
Telling by both of us wearing sweaters today, you know that the weather is changing quite quickly. So normally I'm in a short sleeve or at least just a light button up, but it's cold, but we got something hot to talk about today. And that's why we have Jay here. So,
oh my goodness, yes. So today
What a
we're joined
transition.
yeah, he's really good, isn't he?
Yeah.
Well, we're joined by Jay Bhutani, President and COO of Raintree Wealth Management. Today, we're going to explore Raintree Wealth Management's portfolio solutions. This is a second recording. We originally interviewed Jay, I believe it was May of last year. There's been some exciting changes to the portfolios, and that's why we wanted Jay to join us to share what those exciting changes are. So, Jay, welcome to the show.
Thank you, guys. Thanks for having me back. I didn't think I was ever going to get back on the show. I know you guys are now risen the ranks of the social media influencers, and I just thought I was now too small time to ever get back on this place. So thank you for the opportunity to be a part of this podcast again.
You do know we don't pay our guests, right, to say nice things?
Oh, you don't? Oh.
No.
Oh. So. Okay. Yeah, I meant it all. All right.
Yeah. Well, listen, we've been working with Raintree Wealth Management for a few years. It's been a wonderful referral partner for TVH Financial. Ryan has been referring. We've also added portfolio manager Denis Bazan through TVH Wealth, where he's exclusively working with Raintree Wealth Management. So, Jay, maybe for the people who are meeting you for the first time today, you can provide a bit of background on yourself in terms of your history in the industry and ultimately what led you to Raintree Wealth Management. And then we can talk about some of the exciting changes that have been made recently.
Sure. Thank you. Thanks, Jim. Yeah. So by way of introduction, and for those of you who don't know me, so I'm Jay Bhutani. I'm the president and COO and portfolio manager of Raintree Wealth Management. Been with the firm for about 3.5 years, but as you can tell by my gray, this is not my first rodeo. I've been in the industry for a little over 30 years. I hate saying that number. I used to say 25, but now the number is now over 30 years. I started off as an advisor, just like Jim and Ryan, about 30 years ago here in Toronto. And then about 5 years later, I moved from giving advice to in the investment management industry and building kind of portfolios. And I worked for two firms over the last 25 years. The first firm was a firm called Altamira Investments, which is a direct-to-consumer investment firm here in Toronto. I literally started in the mailroom as a temp, and about 10 years later became head of strategy for the firm, also working on their product shelf and building some of their solutions there. I moved over to a firm called AGF Investments in the 2007 range. Joined there originally to handle their international business, so responsible for their institutional and retail offerings in China, Japan, India, Singapore. And then the financial crisis hit, and they said, Jay, we need you to focus on Canada. So I came back to Canada and became head of product group, responsible for kind of all the retail product offerings that AGF had, and then eventually became global head in 2012. Representing all assets under management, responsible for about $50 billion of investment solutions for clients. So that's a way of my background. I joined about 3.5 years ago at Raintree Wealth Management. Why did I join? I'd worked for very large companies and done some great work, but I was looking for a place where we could grow and make some real changes, and I think really be able to provide what I'd like to say institutional investment management quality to the masses. So I joined about 3.5 years ago. It was one of the best decisions I've ever made, and I continue to look forward as we continue to grow and expand this business.
Yeah, we're happy to have you as part of the team, and we're trying to get the word out with Raintree Wealth Management because I think it's a little secret that shouldn't be a secret. People should be aware of the offering through Raintree Wealth Management, the uniqueness of the offering as well, and with someone coming away from the mutual fund world, and I've sold a lot of mutual funds throughout the years, and
Sure.
I know there's some major differences because a lot of people will ask the question, well, isn't this the same as a regular mutual fund and that I can get at the bank? And it's definitely not. So maybe you can talk a little bit about Raintree Wealth Management's history and the approach as well.
Sure. So the firm was launched in 2017 and is Raintree Wealth Management is a global discretionary portfolio manager, which is not the same as a fund company in that sense. So by being a global discretionary portfolio manager, we offer our services to private clients, institutions, endowments, and foundations. Our focus is really on building what I call institutional class portfolios for clients. And what that means is having much greater diversification and leverage. The old stock bond portfolio, which is probably typical what you get in your mutual funds, which is you get an equity fund and you get a fixed income fund, or you may simplify and buy a balanced fund. That all-in-one solution offers kind of a very basic allocation to the equities and bond markets. Where we want to provide is much more discretionary allocations. And one of the ways we do that is working with some of the best portfolio managers in the world. So Raintree Wealth Management is not the stockbreaker. So, if you call us and says, should I be buying Coke or Pepsi or both, but neither, that's not us. What we do is curate and work with some of the best managers in the world who are specialists in U.S. equities, Canadian equities, fixed income, alternative investments, and bring those managers together and curate those managers to build a much more institutional and discretionary portfolio for our clients. Our focus is really on managing downside protection. Our focus is in making sure your portfolio is well diversified, that it's not just a stock and bond portfolio. Focusing on alternatives. And what we define as alternative is really anything that's not highly correlated to both the stock and bond portfolio. What we want is in our clients' portfolios, find the sources of growth or income that's outside of the traditional markets. Traditional markets can provide a fair bit of volatility, and we've seen over the last few years, and be able to have some portion of your portfolio that is outside of that realm, that is able to generate growth and income, whether that be in real estate, whether that be in investing in private credit, whether that be investing in music royalty funds. Most
Right.
people don't realize that investing with us, we invest in that music royalty fund. You have Taylor Swift and Justin Bieber and NSYNC in your portfolio. Now, people might think that, well, why do I have those people in my portfolio? Well, the reality is, no matter what's happening in the world and no matter what political strife you are, generally speaking, people are going to listen to Taylor Swift's music on the radio, and that pays music royalties, and it doesn't depend on what the stock market or the bond market. That is just one example of where we really want to be able to provide that differentiation. We want to make sure that clients have as many ingredients in their portfolio to manage risk and attract growth long term.
And I admit I do listen to Taylor Swift once in a while too, but I also know
Yeah,
it helps me. It makes me money too now, so that's
yeah,
even
that's
more
right.
exciting.
That's right. Yeah, we
Right?
actually have a playlist. We could send you a playlist that people can play that actually helps invest plays the music off the music royalty fund.
Yeah, yeah. And Ron, you're definitely a Swiftie yourself too, right?
Yeah.
I would probably say, without knowing it, it plays on the radio without me realizing I'm singing along from time to
Right.
time. So I guess I'm singing my way to the bank in some cases. So
Yeah, exactly.
So, Jay, when you say diversify, do you mean diversify beyond just the Magnificent Seven, like a lot of people we know are doing right
Yeah.
now? Yeah.
Yeah, it's a great question. I think right now a lot of the U.S. and exposure people have is predominantly to those Magnificent Seven stocks, and there's a bit of risk to that. So when we think about both the U.S. and Canada, we don't think about them as one large blob. We break it down. Those Magnificent Seven, as they are what they are going to act very differently than a smaller firm. And what I mean by smaller firm is, $1 to $5 billion investment firms in the U.S. or Canada. Those are large businesses but they don't necessarily act and behave like those Magnificent Seven. So for us, part of the diversification is not only just looking at making sure I have different countries, but how do we look at those countries and break them down? So we work with multiple managers like Turtle Creek, who focuses on mid caps, so mid-sized companies in Canada, US. We work with Hillsdale, who focuses on small cap, smaller companies, Canada, US. And actually with Hillsdale, we even have a micro cap strategy. So these are companies that are very profitable, not quite public market companies yet, where we're at attracting real opportunities. Having managers like that in our portfolio and looking at the countries differently is a big difference in how we are able to provide more value for our clients, but also managing risk. If we treat the US or Canada as one big blanket, then you're just going to act off the Magnificent Seven. Well, there's, it's called the S&P 500. What about the other 493 companies that we don't want to talk about? So our focus is making sure we have managers that are thinking about the whole market, and whether it be some part or all of it, but making sure the whole market is counted for and not just kind of the Magnificent Seven. That's what you're going to generally get when people are buying index funds. The Magnificent Seven is going to lead the US, and it's going to generate most of the return. But you look at our small cap manager at Hillsdale again compared to, Canadian markets have done great. I've been an absolutely great year, but our small cap manager is up almost 26 some odd percent this year in their small cap fund. Their micro cap strategy is up almost over 35% this year in their small cap fund. By able to identifying different segments of the market and having managers specialize that are able to provide much better returns, but also help to manage some of that risk. If there's a pullback in AI, well, the Magnificent Seven is going to feel all of it. Having different companies and having companies of different size and scale in your business helps to manage some of the risk.
Yeah, I think, Ryan, that's probably one of the challenges that you and I face when dealing with clients, where they would say things like, well, I've got my money in, the S&P 500 and doing really well. Why should I move it from there? Or I'm doing really well with, 3-4 stocks and some gold and Bitcoin, right? And one of the things that I kind of remind people of is, if you had put your money in the S&P 500, for example, like 100 grand back in 1999, by 2012, it was worth $85,000. Like, you basically went about 13 years where there was zero growth, where having your money in a diversified portfolio where, again, it's generating, different distributions and income and growth and whatever else, the likelihood of that happening, of having a negative return over a 15-year or a 13-year period, I can't say it's impossible, but I'd say it's not probable, right?
Yeah,
So
historically,
that's
it's never
definitely a
really
challenge.
happened. Yeah, yeah,
Yeah,
yeah. And I
and
think
then the other one too. Go ahead. No, go ahead, Jim.
no. So please go ahead.
No, I was just going to say, and even going back to the Magnificent Seven, like right now, we're reminding clients of what happened in Nortel. We're reminding clients what happened to BlackBerry. Like, I remember at the time living through those situations where no one ever thought Nortel would ever cease to exist, and everyone thought that BlackBerry would just keep appreciating in value, right? And we're kind of seeing some similar behavior with some of those AI stocks, right? And being fully invested in those stocks, I think is a major risk for a lot of people, right?
Yeah, I think obviously, I want to first off say that there's nothing untoward the Magnificent Seven. Those are great names. NVIDIA is a great company. Meta is a great company.
Yeah.
It's just that you want to make sure your concentrations are appropriate. And I think that's, to us, the most important part is, yes, you absolutely need the Facebooks, the Metas in your portfolio, but you want it to drive your entire return. And that's where the diversification matters. To your point, these companies will not go up forever, and there will more than likely be a pullback in the market. That's where the diversification helps it. And especially if you're singularly focused, those Magnificent Seven are all somewhat interrelated companies now. If you saw now, they're all investing in each other, right? It's part of the AI boom that's happened. And for us, we see real value there. We've seen some real growth. This is not, and I will also caution to say, this is not like the dot-com bubble. The dot-com bubble is very different than what we're seeing today. The dot-com bubble was built on complete speculation where companies were not making any money. They just had a website and they thought that was good enough. NVIDIA is a highly profitable business. Google is a highly profitable business. So these are highly profitable. These are not speculative businesses. So I want to just make sure that, but you also want to make sure that your entire portfolio is not technology driven. And that having that diversification, having more ingredients in the portfolios, key component, and that's why we also don't only work with one manager in the equities. We work with several managers. We work with 9 different managers in the equity market because not everyone's going to see the world the same way, and that's okay. We do want somewhat different schools of thought. The worst thing we also want is everyone thinking the world is going to never end. Well, that's usually the sign of something is terrible is going to happen. So we want managers to have different schools of thought. We want to understand their rationale for being either very pro of the market or being much more conservative. We want to understand that and we partner those together to make sure that helps managing that risk. One lesson I learned because you and I, Jim, went through the tech wreck together with a lot of other clients. But what ended up happening was a lot of groupthink. Everyone thought, oh, all these stocks are just going to go up and I can throw my money at everything. And it feels a little bit like that right now. And, because people are buying, index funds weren't around back in 2000 and then now you can get access to it now. And people are making commodity trades like gold right now and Bitcoin. The problem is, when I talk to clients they're like, yeah, Jay, I don't need to come to a portfolio manager. I'm up like 25% because I've been gold. The problem is they won't feel it now, but they will feel it when there is a market correction. And, I like to, clients generally always look at us sideways when markets are going straight up, but then all of a sudden they really truly value us when unfortunately markets pare back. Markets like 2022, markets like 2020, I can go back on and on. Those bad years or negative years can have a dramatic effect on your overall portfolio return. And having someone there, whether it be us or someone else, helping you navigate those poor markets is really what's ultimately going to provide you better risk-adjusted return. Otherwise, yeah, then just get the index fund. But when the markets pull back, you're going to feel all of it. For us, our objective is for you to not feel as much of that pullback. Our objective is to have much less downside capture than the average market. And that I think helps to add value.
Yeah, I mean, some of the examples that we're working on right now, Jay, are client 5 years away from retirement, 95% of the holdings in NVIDIA, Apple, and Amazon. And they've done really well, right? But the concern is there's going to be a pullback at some point. What are you going to do? You don't have time to recover, right?
Yeah.
We're dealing with other clients who are in their 70s who say they're conservative investors, and yet half their assets are in gold and Bitcoin, right?
Yep.
And it's difficult to kind of justify rebalancing, right, with a client like that because they've done so well and they keep thinking it's going to continue on growing and increasing in value. But you and I and Ryan know that there will be a pullback at some point. The problem is, and I still don't have my crystal ball from Amazon, we just don't know when that's going to happen. And when they do happen, usually it's fast and hard and it's scary, right? And this is why we encourage people to look at a portfolio solution, right, as opposed to being concentrated in the way that we're seeing a lot of people invested today, right?
Yeah, you make a really good point. When the market turns, I like to say it's like a punch in the mouth. And everybody, generally speaking, could duck a punch they see coming at them. But the problem is when the market moves, generally you don't see that punch. And so you need to have your guard up already beforehand. The problem is by the time, April was a great example where, if you remember, all of us probably remember World Liberation Day on April 1st, when the President of the United States got up on the front lawn of the White House with a big board and says, I'm going to tax these various countries. And the markets just melted. Within 2 weeks, markets were down 16%.
Right.
There's no way, if you are an investor, you were prepared for that. No way. You had no idea he was going to get up on the front lawn, and you had no idea what he was going to say, and you had no idea how the world was going to react to it. And so you do not have time to pivot. However, when you have a well-built, thoughtfully considered, diversified portfolio, we can take the sting out of it. So April was a bad month. Markets were down, like I said, 15, 60% by the middle of April. By the end of April, markets are down 5 to 6%. Our average client was down less than 2%. Right? And that's So what that matters is, if you looked at May was up about 2%, which means that our average client was down 1.5 to 2%. May, we got it all back, and we're growing again. While the average Canadian, if they were indexed, took it all on the chin on in April, having to wait for May, June, and maybe into July before you recovered those losses. And so now you've also given up 3 months of return to get yourself out of a hole. And that's the value. And that's, people don't see that, but that's the value of managing your downside. If you can really protect against the lowest possible markets, that provides a better risk adjusted return. And, math has shown that. So you don't have to hit home runs. That's the problem, I think, right now with investor sentiment is, oh, I could just throw money. I'm going to get double-digit returns. I don't worry about risk. We worry about risk even in good markets, because at some point it will turn, and you'll be thankful that we were worried about risk the entire time.
Yeah, and I also look at psychology of money, and a lot of people who do self-manage their funds, they're down 16%. They typically, I hate to say it, they'll pull out of the market at that point, and then they'll wait till things are more comfortable and they get back in again. So ultimately what they're doing is they're selling low and buying high, right? And then they don't understand why they have a poor rate of return over a period of time, right? It's because they're reacting in a way that they shouldn't be. It's difficult not to react that way, right? But when you're down 16%, in order for you to break even, you're going to need about a 18 and 19% positive return to break even, and that could take some time. When you're down 2, you need about 2.1% on the positive side to break even, right? That happens it happens a lot quicker in terms of a rebound. So that's the style, right? And let's talk about the portfolios and who they're really for. And maybe that's changed a little bit too, because when I first started with Raintree Wealth Management, I believe it was just 2 funds, right, that kind of constructed the portfolio. And now we have 4. We have a core equity, core fixed, enhanced yield, and alternative strategy. So maybe talk about what, the portfolios prior to the change and then post change.
Yeah. So when I joined, as you mentioned, Jim, we had 2 funds that essentially were the building blocks for our portfolios. The challenge with that, and it did well for us, but the challenge was that it didn't offer a lot of customization, because you essentially had only two kind of 2 funds to work with to kind of reallocate and diversify clients. So we had started this plan last year in 2024 of how can we offer more clients more customization and more diversification. So what we decided to do was break apart our old 2 funds and essentially create 4 funds. As you mentioned, our core equity fund, our core fixed income, our enhanced yield, and our alternative strategy. The funds now offer much greater diversification. By now creating individual funds specific to an asset category, we're able to introduce many more managers into our portfolio. So one of the major changes is the number of managers we work with. When I first joined, we had 5 managers in our portfolio. Today we have over 40. So you're getting a much greater diversification. So now we're not only diversifying across many different investment opportunities, we're also diversifying within. So within our equity fund alone, we have 9 different investment holdings there. Also managing currency risk there. People talk about the equity fund returns, but they don't talk about the currency part of it. The U.S. currency has pulled back. So some people who say, you know what, the U.S. market's done well, but my U.S. ETF hasn't done well. Well, did you ask yourself, have you hedged the currency? Because the U.S. currency's pulled back 11%. So that's something we did. Fixed income, we still work with one of our original managers, Boyce & Gordon and Payne, who's a great fixed income manager. We work with them, but we've added several managers there. We've added investments in private credit across both our fixed income fund and our enhanced yield fund, boosting the return profile, but not adding any additional risk. And then our alternatives fund, which has become I would say, a very popular fund for us, offering monthly liquidity to our investors, invested in over 19 different strategies that I mentioned. Some of the top hedge fund managers in the world, music royalty fund, global real estate. You'll be invested in some of the largest global private equity funds in the world. You'll be invested in private investments in Canada that typically have amazing growth trajectories, but they tend to have very long settlements of being invested in 5+ years. You can invest with our fund and offer still monthly liquidity, and so are able to access those strategies. So by having those funds broken apart, now we can customize at a much greater degree. When I first joined, we offer 4 portfolio solutions.
Right.
Today we could theoretically offer an infinite number of theoretical solutions. Just as a base, this is a base offering. We have 24 portfolios just as base offering, and then we could customize off those. So clients who want higher allocation to alternatives, or more focused for income, or more focused towards having 100% liquidity, we can customize those solutions for it. And that has really changed the way our business is in terms of how clients now can customize. And I should highlight, that's not customized at the client level, that's customized at the account level. So if you have an RSP versus you got this account that you're going to be buying a boat in 5 years, yeah, we'll invest that differently than we'll invest in RSP versus your TFSA. And
Right.
maybe the two spouses, a husband and wife, see the world a little bit differently. Well, guess what?
Yeah.
We can also invest theirs individually, as people may have different risk components. So that by breaking those funds apart, we're able to offer a lot of great customization. The only lesson learned from launching the funds was we also launched those funds on April 1st, which was not
Right.
intentional. We didn't intend to launch our funds on World Liberation Day. That was not intentional. I wouldn't recommend anyone launching funds on a day when someone decides to melt the markets.
Right.
But we did, and we withstood that. And that actually
Yeah.
helped us kind of find out kind of in real time how true our proof was in terms of our portfolio construction. Like I said, our portfolio has held up really well for April, and our performance has been outstanding.
Right. So can they customize it in such a way then, Jay, that, for example, Ryan and I, we do a lot of insurance types of investments for clients. So I would say definitely lean towards the more conservative kind of guaranteed solutions. But sometimes we'll have clients say, you know what, I know I have X amount of dollars in seg funds and whole life insurance, whatever else, but I really want some exposure in the alternative strategies because I really like that. Or I really want the core equity fund as part of my overall portfolio with whatever else we're doing. Is that possible?
Absolutely, yeah, and that's a great question. A lot of clients do have, work with other portfolio managers, have funds, and have, let's call it, broad market exposure. And generally, probably Jim and Ryan, you probably know this. Most clients probably don't have enough alternative exposure in their portfolio. So absolutely, if clients want to come to us and say, you know what, I've got my equity covered, I've got enough fixed income, I don't really have enough alternative. Yes, we're absolutely happy to talk about just that one fund as an investable option. Again, that fund has monthly liquidity. And if clients are like, you know what, I really like your core equity fund, I want some active management. Yep, absolutely. We can offer that client placement in there, and that fund offers daily liquidity. So as you just highlight, our core equity and our core fixed income, our daily liquidity, our enhanced yield, which has also become a very popular solution for those clients who want kind of a steady state of income. Enhanced yield is targeting to pay 8% annual with monthly distributions fixed. So especially clients who are looking less about growth and looking a little bit more income and want just something that'll help to supplement their income, yeah, we can absolutely put them into the enhanced yield as an individual solution as well, or mix and match. So clients may just say, you know what, I don't want any fixed income exposure, just looking for equity. We can customize a solution that way as well.
Right, which is perfect because it's either, I know there are portfolio managers, and not to say that you would want every single investment dollar from a client,
Sure.
right? I mean, we all
Sure.
do. And a lot of portfolio management firms that we are aware of, they just wouldn't customize the way you have, where you could turn around and say, okay, give us a piece, right? If this is the part that you really want us to manage for you, we'd be more than happy to help you with that, knowing full well that at some point they may want to transition more into the portfolio because they like how it's working for them. They're quite happy. And I do find as people get older, especially the ones that are managing their own money, they find it more difficult when they're dealing with the volatility and the uncertainty. And they definitely kind of want to give that responsibility off to somebody else who's a professional, who's a professional money manager, right? So I do like the fact that it is customizable in such a way where if a client says, I just want this one piece right now, and maybe down the road we'll get more, and they will get, you will get more because they're happy with the service, because the service level at Raintree Wealth Management, I'll have to say, is like A1. We
Thank you.
deal with a lot of the people in the back office as well. So it's not just about the portfolios and the performance. Obviously, that's number one in most people's eyes, right? But if you have a wonderfully performing portfolio and the back office is horrible, like it just eventually people are going to make a change, right? But you get the great portfolio solution, you get the customization, and you have wonderful people that you're working with who really care about the client. And I think that's the biggest difference from the AGF world or the mutual fund world, where I kind of came from, the banking world. It's very different, the level that we're at right now, because we really get to truly know our clients. We get to know their families. We've, learn about their goals and their dreams and their aspirations, and we really care what happens with their money, right?
That's right. Yeah.
Yeah.
And I thank you for very kind of you to say those kind of words. I'm going to give, I take no credit. I'll take some of it, but I take most of the credit goes to Aditya Seg and Ashley Brady, two team members who run our back office and operations group. They have made it their mission to make life as easy as possible for clients. The one thing that I recognize very early on is whether it's $1 or $1 million or $10 million, every dollar is important to our clients. And we treat every dollar as that. And we treat it with the respect it deserves. So the last thing we want our clients to worry about is, hey, what's going on in my account? I haven't heard from Raintree Wealth Management. That is the worst feeling in the world. I can imagine, you can imagine, Jim and Ryan, when April was happening, I'm sure clients were calling you, going, what's happening in the market? What does this mean for my account? The worst thing that for a client to feel is that they're not being heard when they're asking that question. So for us, it's really important that we communicate with our clients, we understand what their concerns are, and follow up is a big thing. So yeah, we do pride ourselves. That was one of the big things we changed when I joined. It was really focusing on the client experience. And I would argue that we have one of the best teams that are really focused on that client experience. To your point, you can have the best mousetrap. Like I just like to say, you can have the best mousetrap in the world, but it's hard to do business with and not easy to communicate with. No one's going to want to do business with you. So for us, we want to make sure that our clients feel respected, and we make sure that clients' emails are returned within a couple of hours at the latest. Focusing on our client experience is really important.
Well, it's not just the client experience, also the advisor experience, right? And by making it easier for the advisor who's recommending Raintree Wealth Management, again, makes it easier for us to work with our clients and service them as well. So I'll definitely say, from an advisor experience point of view, A1, again, zero complaints from my end, very happy. So we appreciate a lot of the changes that you've made since joining Raintree Wealth Management. I will give you the credit for it, because I've seen the difference. So we do appreciate that as well. Yeah.
Well, like I said, I understand. We have a responsibility to Raintree Wealth Management. Advisors like yourself put their trust in referring clients to us. So we look at ourselves as an extension of your business. So we want to make sure that the service that TVH is provided, we uphold to that standard. So our clients don't feel like there's any drop off TVH. We work with Raintree Wealth Management. So that's, you guys set the bar and we just meet it.
Yeah. Well, Jay, Ryan has been unusually quiet, and I have a feeling that he's actually listening to Taylor Swift right now in his
That's right.
headphones.
That's right.
And not listening to us. So
New Taylor,
Ryan,
old Taylor.
Smiling on the inside, of course. So, no, there's really not much to say. It's really for people who are listening to understand the difference that they're experiencing, both from TVH as our group and Raintree. And, you speak about April happening. The only clients that I had reach out to me, and I can't speak for Jim, but were the ones that still had their money managed by big, large institutions. I won't make names or colors to them, but they were very cookie cuttered, and they put that person in a box, and that was their investment. And, I can't speak about the importance of people understanding how Raintree really helps protect to the downside, that, as you very openly spoke about, like being able to tailor somebody's individual, because coming from and leaving kind of the mutual fund world of looking at 10 different mutual funds and being like, oh, look at the top 20 lists. They're all the same amongst all 20 of them, right? And what I often challenge many of our clients is, whether it's a previous advisor or potentially going to the bank, ask that person, what is diversification, right? And ask them what diversification is, because diversification in the answers that they're being given to the client is not diversification. It's, again, that same cookie cutter kind of, here's your mutual fund, and that's it, and you're going to be in this balanced fund, but that really means nothing for a lot of people. And it has made my job easier, and it has made my clients' lives a lot easier to sleep at night, knowing that on the downside of the market, I'm not getting a phone call. I'm the one making the phone call to them to do our kind of yearly or quarterly check-ins, but there's very rarely a big conversation. And then again, those conversations are often the money that they've left at the banking institution, right? Or potentially an advisor that isn't checking in or doing potentially their job, right? So
Yeah,
Or the
we
online
one of the
platforms
things
too that offer no advice, right?
yeah,
That's the other part that people don't understand. There's no advice given whatsoever.
yeah, I think one of the things that we definitely saw in April was clients calling in saying, "Oh, you know what? I just saw this world liberation. The markets are kind of going topsy-turvy. What's going on?" And I spoke to a lot of clients, picked up the phone and talked to a lot of clients. And, usually after about a 5-minute conversation, they felt pretty good. And then at the end, they were like, wow, I actually got to speak to someone. Like, and and to most people, you have to understand, not everyone is a portfolio manager. So clients are going to see headline news. They are not calling me up to say, Jay, you should sell equities and you should be buying this. That they don't know. That's not their job. That's my job. But they want to be assured that someone's paying attention and somebody is watching there. Because, that's when markets are doing things like that, they just want to know that their account is not being ignored. Like, am I taking the brunt of what's happening in the market? So most of the times, I just have to assure clients, yeah, we're paying attention. This is what we're doing. Actually, we see this as kind of a short-term dip. We're actually going to be buying into it. We see some opportunities here. And clients, after about a 5-minute call, just feel acknowledged. That's all it really is. They feel acknowledged, they felt heard, and that's something that we pride ourselves on, and that a client can access me. You're right. Some of those large institutions, you can't get to anybody that's actually managing your money. And if they're managing your money, you're one of a unit holder in the billions of dollars of funds. And to your point, Ryan, you made the point earlier. These are generic funds built for the masses. So there's no customization for their individual client. So, what is that portfolio manager supposed to tell you, right?
and the reaction time, many times I have a conversation with a neighbor, and he just keeps saying, like, the institution cannot react to the market the way most do, right? And he trades himself, and nobody can react as soon as somebody who's just constantly trading. But that can be a huge difference for people. You guys are looking at the markets, not just when your neighbor's talking about all their big returns. You're preparing for all of these things. And that's where I see a lot of clients, especially older clients, that are comfortably coming to the Raintree platform and saying, hey, I want to be protected on the back end too, in case something, because this is my retirement. This is my legacy being passed on, and I don't want somebody to take a big bite because they were asleep at the wheel. And that's what we're seeing sometimes. So
Yeah, and I want to make sure everyone. I don't want everyone on this call to be it's all gloom and doom. That's not what we're saying.
No.
The markets have been really good. And if you highlighted, Ryan, or the conservative clients who want to manage risk. But just because you're conservative doesn't mean we shouldn't also try to achieve some level of growth. To give everyone context, our preservation portfolio, which is our preservation core plus portfolio, which is our most conservative portfolio we have, it has been around since 2017. The 3-year number on that portfolio, annualized, is 8.67%. So, to give clients context, a very conservative portfolio, highly diversified, managing risk, but we're not necessarily also sacrificing the upside return. I don't want that to be lost on everybody. I don't want this entire call to be about, oh, the sky's falling. Raintree is going to be really good when the sky's falling. Oh, Raintree can also be pretty good for you when the markets are going up. So I just want to make sure that message gets across. So even our most conservative clients are generating, 8.5%. A 1-year number on the preservation portfolio is over 7.5%. So even, clients who are incredibly conservative do also deserve to achieve some level of growth. while being conservative. And that's our responsibility as well. I don't want for people to think that we're going to be super conservative, which means we're not going to, we're not going to be participating in the upside. We are going to participate in the upside. I will tell you right now, Raintree Wealth Management will never catch 100% of the upside. We're not intending to. We're going to be too well diversified. So, our goal is to catch 80 to 90% of the upside of a market and catch 60 to 65% of the downside. That asymmetric capture is essentially how we add value.
Well, listen, I mean, the level of confidence that I have in the platform is quite high. And that goes back to when you and I first met. And I saw your vision. You shared your vision with me. And, part of me is just like, okay, well, Jay's the most interesting man in the world. So I want to kind of get involved there with him. But part of it was also the vision that you shared. And, in saying all that, we now have Denis Bazon, who's the portfolio manager through Raintree Wealth Management and TVH Wealth. And there have been some major benefits to our clients by having Denis part of our team, right? Specifically when things do kind of go in the markets slightly sideways and people are concerned, for us as advisors to be able to say, hey, you know what? We're going to schedule a review meeting because we want to make sure that all of your assets are performing the way we'd intended for them to perform. And we're going to also include the portfolio manager in that meeting, and he's there. Like, that's so important with a lot of clients, where I know in the past I've struggled with other relationships that I've had where it's just like, okay, it sounds like the world is falling apart and we're going to need 2 weeks to have someone talk to you about it. Right. We don't deal with that by having the unique offering. And I know with you do a really good job, Jay, of making sure that you're involved in those meetings, as other advisors need you to be involved as well. As the president of the company, like, that's very important. Again, that means a lot to a lot of people. So, I will keep singing the praises because it's been a great relationship, and we're quite happy with our affiliation with Raintree Wealth Management as well. And I know a lot of our clients are quite happy as well.
Well, thank you. Like I said, I think this has been a great partnership with TVH. I think, I know, Jim, you were probably a bit skeptical when I first came aboard, like, okay, he's got big plans to want to make changes. And I wouldn't say it's been a perfect conversion, but we've done quite a bit. We've earned quite a bit of loyalty from our clients, and we've repaid them with much better service, performance, managing risk, and now our clients are. I can say I've been doing client reviews over the last few months, and it's been the best part of my job is saying clients saying thank you of minding their performance, their risk, but also be able to help with their retirement is it's great to see. So thank you for your collective partnership, TBH. I know you were one of the early adopters, and I thank you guys for partnering with us.
Yeah, well, we want to thank you for joining us today. And what I would say is, if anyone out there is watching or listening, first of all, no, Ryan is not going to be dancing to Taylor Swift on a TikTok video. We haven't authorized that as of yet.
No.
But secondly, if you really want to know more about Raintree Wealth Management, what I suggest you do is reach out to us at TVH. So you can find us at tvhfinancial.ca, tvhgroup.ca, or you can go directly to tvhwealth.ca and you'll be able to see Denis and connect with Denis directly. Obviously, you can call us at 647-727-4668. Good old-fashioned email works too, financial@tvhgroup.ca. Ryan, how else can they ask us questions or find out more about Raintree Wealth Management or any of the services that we offer at TVH?
Well, of course, all over social media, but they can give us a call, which you would tell us the number about. But,
I already did. Okay. Yeah, we already shared their number. Yeah, we're good.
Yeah, but TVH Financial, I can't remember what else you said. You said everything, so that I remember.
All right. Well, what other services then do we offer through TVH Group that people might be interested in?
The group, well, TVH Legal, which I think I can hear in the background from you. TVH Cash Flow Solutions. We have accounting. We have mortgages. So we've got a whole slew where, from start to finish, we can really help a family or business really get them set up for success.
Yeah, absolutely. Well, Jay, once again, thank you very much for your time. And until next time, we will see you again. Take care.
Thank you, guys.